Financial management. What? Don't fall asleep on me yet. This is going to be fun. Less than an hour of why you need to do a budget, what is IRS reporting, what is a 990? Have you heard of UBIT? Why is that important? We're going to talk a little bit about investment policies, reserve policies, and why that is critical for your organization. Here we go. A key component to the financial stability of your organization is budgeting. It is important. So we're going to talk a little bit about income and expenses and how to do it and how often you need to be checking your budget. We're going to talk about the budget process a little bit right now. The budget process starts with you and your team. You know what you're spending money on and what revenue you have coming in. You also know where your membership dollars and your sponsorship dollars are coming from and whether or not you can increase that in the next year. So when you start your budget process, take a look at last year's actuals. Pull a full year. No matter where, if you start it in the middle of the year, you don't have to start at the end of your fiscal year. If you start it in the middle of the year, take a full 12 months and plug your actuals of what you actually did, income and expenses, into the next year's cycle. After you've done that, take a look at the bottom line. Are you on top of it? Are you in the red? What's going on? If you have to cut your expenses a little bit, do that. If you're planning to hire a new employee, add that in. And then let's take a look at that revenue. Increase that membership number by 5%. Increase those sponsorship dollars and that event revenue because you're going to do a better job next year, right? We know that throughout the year, and as you do this, you're going to be more financially responsible with your expenses. You're going to bring in more membership revenue. You're going to bring in more sponsorship dollars. You're going to bring in more event income. So it's super easy. We're going to take this budget process, chop it all up, and make it easy. You've decreased your expenses, you've added that person, you've increased your revenue. Now take a look at that bottom line again. Are you where you need to be? Are you trying to build your reserves? Do you need a surplus budget? We'll talk a little bit about that later. But once you've done that, now you're into your budget process and you know exactly what you need to do for your organization. When you have some really key changes in your budget from one year over to the next, make note of that so that you can explain that to your finance committee or your board. So now that you've completed your budget with your team and everybody knows what revenue they need for different things and how much everything's going to cost, now we take it to our finance department. If you have a finance department or finance committee, you take it there. If not, you take it to your executive board to review. Get a feel for how your board is going to vote on your budget. And then after you've talked through and answered those questions, you're prepared to take it to your full board of directors for approval. We're going to play a little game now, true or false. Your budget has to balance. False. You do not need a balanced budget. It does not need to break even. So there are three types of budgets. You have a surplus budget, a balanced budget, and a deficit budget. The reason that you have a surplus budget is because you want to put money into the bank. Maybe you want to put money into reserves. You want to save up for a new staffer, a new employee, a new piece of equipment. There are lots of reasons planning ahead, and this is why we're talking financial management and budgeting, right? You need to plan out 18 months, 2 years. Where's your organization going, and do you need to save money? So if you have a surplus budget, what you're doing is you're saying your expenses are going to be a lot lower than your income. Okay, so when you plug in all your expenses into your budget, you plug in all your revenue to your budget, that bottom line is a great big number that's in the black, right? No negative numbers here, no zeros here. It's a great big number in the black. That is a surplus budget. A deficit budget is a little bit different. Now you ask me, why would you ever have a deficit budget? Well, you may be making investment into your organization and bringing reserves into your budget because you're making a large purchase or because you're hiring that staff person and you're increasing and growing your organization. So a deficit budget means you've plugged in that need that your organization has and you're able to bring in reserves to make that happen. Or you don't even need to bring in reserves. Maybe you have a large balance in your bank account and it's okay and your board has approved digging into the red a little bit and going into that checking account. A break-even budget is exactly what it sounds like. Your expenses are exactly the same as your revenue. You're going to spend as much as you're going to bring in, and you've balanced your budget. Even if your budget is off by $3, when you've plugged in all of your expenses and plugged in all of your revenue, and it says that you are in the red by $3, you're going to decrease those office supplies by $3 just to make sure that you have a balanced budget at zero. So surplus budget, deficit budget, break-even budget. You can have any of those, and it's what's right for your organization in that year and what your board adopts and what your membership is cool with. I'm making it sound very easy because if you just sit back and don't get stressed about it and you're looking at your actuals and you're plugging in your numbers, it doesn't have to be rocket science. You don't need a PhD in mathematics or accounting to get this done. I'm going to give you a couple of tips that's going to make it even easier for you. Be realistic in your numbers. That's why I always pull the actuals from last year, and I take a look at 2 years prior to that too, so I can see some trends. Are my numbers decreasing? Please let the answer be no to that question, but you can see a trend over a couple of years. Be conservative. If you think that you spend $500 a year on office supplies, then put $500 a year on office supplies in your expenses. Don't say $700 or $800. Be conservative. And if you think that your major event always nets you $20,000 a year, don't put $30,000 as a profit item in there because you want to balance budget. Make sure that it's $20,000 because that's where you have seen the trend be over the last several years. Involve your team on all levels of this process. They know where money is being spent just like you do. And you may overlook something because you have 14 things going on that day and you've got to do your budget at the same time. They may bring something up that you have overlooked. Keep notes on your spreadsheet as to why you budgeted at various levels. This, again, is going to be helpful with your finance committee, with your board of directors when you're explaining why your budget is the way that it is. And if your board wants to move money into reserves and your budget allows it, you can add that line item into your budget to make sure that you don't, as you're looking at your P&Ls every single month with your board of directors, you have that money allocated to go into reserves. The less predictable your budget is, the more you want to budget for contingencies. So this is especially true for new organizations or organizations that have had a major change in leadership or something has happened. Something, tremendous has happened in your organization and now you're a little bit unpredictable about events, revenue, sponsorships. You want to make sure that you budget for those contingencies. Create a narrative in your notes that go with your budget, so that you can explain the rationale to your membership as well. Outline costs of programs and events. Each committee should understand the costs associated with their event. So if you have a committee that's running an event, a golf tournament, for example, what is the insurance on that golf tournament? What are the whole sponsorship signs going to cost you? What is lunch going to cost? All of those costs need to be in the budget for that event. You also want to make sure that you have staff costs in there. A lot of people do not put staff costs into the cost of the event when budgeting. Starting a budget from scratch is called zero-based budgeting. You don't need to be bound to last year's budget. And staff need to understand the budget at all times. If your staff has access to one of your organization's card to go out and buy office supplies, stamps, paper, they need to understand the budget and where you are each month in the budget so that they know to be conservative with those new fancy pens that they love so much. Budgeting for the future is important. When we're creating this year's budget, it's also important to look and consider next year and the year after. As you create your budget for the upcoming year, consider what the following years look like. Is your revenue trending on membership and dues upward? Are your events trending upward? Sponsorships trending upward? Do you have one-time expenses coming up that you need to fund in coming years? Are you planning for growth? Are you cutting down a little bit on staff and overhead in your organization? Are you budgeting for inflation? These are all things to consider when you're doing your budget and looking forward to the future. Key performance indicators. You've heard of KPIs, but do you really know what they are? And do you know what you want to measure? Let's talk a little bit about that. So KPIs help an organization measure its progress toward defined goals. They reflect the organization's goals. They are meaningful to the member, the donor, and the board of directors. They are simple, understandable, logical, repeatable, and measurable. They are clearly defined. They are long-term considerations, and what you want to do is limit your KPIs to factors that are essential to reaching the organization's goals. A smaller number of KPIs will keep people's attention focused on achieving them. KPIs are directly tied to your strategic plan. Do you know those board members and committee members, or even a member that says, I have the best idea? When I have an idea is said in a board meeting or a staff meeting, does it fit with the strategic plan? Does it fit in with your key performance indicators? KPIs give everyone a clear picture of what needs to be achieved. You can update them monthly so that you know where you stand on your KPIs. Are you meeting your goals? Are you falling short? Post them in lunchrooms at your office if you need to. Use staff incentives for reaching these goals. I'm going to give you a quick example of one thing that I do with my team. If we have a conference coming up and we want to make sure, always my team wants to make sure that we have brought in more attendees than the previous year, always. So I'll put a little incentive in place that says, okay, if we want 400 people at our conference, if we get to 300 people 2 months out, everybody gets a free floating holiday. Just whatever day you want off. Your team will work their tails off and they'll work together like you've never seen before to get a free day off. I've tried money, I've tried gift cards, but you give them a day off and they will work really hard together to make that happen. And then when you hit that goal, you hit that 400 person goal, maybe it's another day off. Maybe your entire team goes out for lunch one day and do an escape room or go bowling or something fun like that. We've done that with our team and it really is effective. So using your team and incenting your team to help hit those key performance indicators is a great idea. So now I'm going to give you a couple of examples of key performance indicators that you can use in your organization. Membership growth in each tier of your organization. So whether you do it based on number of employees in an organization or revenue growth or just by business or individual, whatever tier it is, you want to have a key performance indicator. Percentage of membership market share. Where is that? Where are you at? Membership retention rate, visitors to website and Facebook, ratio of membership dues income to non-dues income. That's important. Number of members enrolled in or taking advantage of key programs and events. Number of contacts with government to support lobbying. If that's something your organization does, that's a great KPI. Number of mentions in news media. Number of member calls to the office for technical assistance. Let's talk a little bit about measuring marketing data. This is important. You're spending marketing dollars or you're spending time on social media, and is that time effective? Website traffic, you want to measure unique visitors, organic searches. Organic traffic is a measure of how valuable your content is. Keeping this number high means maintaining a consistent focus on writing, podcasting, image, and video quality. New leads, incredible important KPI. Visitor to lead ratio, lead to member ratio, landing page performance, email click-through rate, blog traffic, blog subscribers, keyword ranking, diversity index, engagement index. Marketers should be able to rattle these numbers off easily. They should know where they are now and where their goals are. So you always want to know your KPIs, you always want to know where you're at, and you can share these with your board in board packets. They're also, when you are knocking it out of the park, a great thing to educate your members on. So we've talked a lot about KPIs and what you should measure, and you can just picture this never-ending spreadsheet of numbers, right? Where you are, where you want to be, and all of these different places. So let's talk a little bit about dashboards and making this all look pretty. Because if you create dashboards with really cool graphs, it will help your board to want to look at the information that you're giving them. So numbers are super fun for me, but some people just glaze right over, and you want people to be passionate about your key performance indicators and how you're doing all the time, because so they feel vested in this organization. KPIs can be transferred into dashboards through graphic depiction of the data. Dashboards allow the board and staff to watch the trends from quarter to quarter and year over year. You can identify strengths, you can identify weaknesses. Dashboards also reduce the need for oral and written reports at board meetings. So if you add the dashboard to your board packet, it can be approved with the consent agenda. There are several dashboard software packages, but you can also find templates in Excel or in SmartArt in Word and PowerPoint. And if you speak Mac fluently, there are many options on that platform as well. So we're going to talk a little bit now about how to read nonprofit financials. Cash versus accrual-based accounting. What? So cash basis accounting recognizes income and expenses as they occur. Think of your checking account. Income is recorded when it is received rather than when it is earned. We're going to talk about that in a second. Expenses are recorded as they are paid rather than when they are incurred. Accrual basis accounting your accountant's favorite type, recognizes income when it is earned rather than when it is received. Think about sponsor pledges that are received into your books even though they have not been paid yet. It also recognizes expenses when they are incurred rather than when they are received. Since all expenses and revenues are eventually recorded, accountants generally say that over time the difference diminishes between cash method and accrual method, but nonprofits find it easier to use the cash method. This eliminates going back in to adjust a donation that was pledged but never received. You'll want to talk to your bookkeeper or your accountant about what method of accounting is best for your organization. Let's take a dive into accrual-based accounting, get a little bit deeper with that. We already talked a little bit about recognizing revenue when it's earned and when expenses are incurred. Here's an example. Purchasing office supplies with a credit card in April and paying the credit card bill when you receive it in May. Accrual recognizes the expense in April, cash basis recognizes it in May. Many like this method because it allows for better budgeting and planning. It looks at when the liabilities are incurred that might otherwise be forgotten. Accrued vacation is a great example of that. If you're using generally accepted accounting principles, GAAP, accrual method is required. Audits under GAAP generally require accrual method accounting. Now we're going to take a look at a profit and loss statement. This is a fundamental report for your board packet every single month. Sometimes you take a look at profit and loss just for the month. You also take a look at profit and loss year to date, and you take a look at profit and loss year over year comparison. So let's take a look at a profit and loss comparison. We're going to look for key differences inside the statement. So let's say we're taking a look at January 2018 versus 2017 and the change in the years. Okay, what you want to take a look at is what's different? What are the significant changes from one year over to the next? You'll see on the left-hand side of the screen, January 2018 compared to January 2017, and the change, the monetary change in year over year. You can also look at February and March comparison. If you take a look at the far right, you're going to see year-to-date January through March 2018 versus year-to-date January through March 2017. As you go through this report, before your board meeting, you want to take a look at what are the big changes. Is your membership in 2018 significantly different than 2017? And if it is, you want to make a note of that. You want to let your board know, why is that? Are you having a membership drive? Did you have a membership drive in January of 2017, but you're planning it for 2018 in February? So is that why maybe you didn't see the revenue or recognize the revenue in January, but you saw it in February? Also take a look at the total income. Where are you at this year versus last year, and make any notes to your board of directors on that. Same with expenses. As you go through the different line items, where are you off? And make note of why that is. When you get down to the bottom line, where are you this year compared to where you were last year for the month, and then also year to date. Now we're going to take a look at a balance sheet. A balance sheet, as we walk down through it, you want to date it to the month prior because as you reconcile, that's where you want to be. And check that you have the correct method in your books. If you operate on a cash method accounting, you want to make sure that your report is cash basis. If you're on accrual, you want to make sure that you ran your report in accrual basis. This is a snapshot in time of all of your assets and liabilities. It's going to show you all of your checking accounts, your savings accounts, CDs, investments, equipment that you own, your assets, your liabilities. It's going to show you your open balance equity, it's going to show you your net income, your total liabilities and equity. Now we're going to take a look at a budget versus actual. This is incredibly important and something that you want to be taking a look at with your board every single board meeting. With budget versus actual, we take year to date, and year to date will show you the month that you're in and also all the months leading up to that month. The last column will show you the entire year. Here's where you want to take a note of any discrepancies that you have in your budget. You want to make sure as you go through the year that you are staying on budget. There's not a whole lot more to say about budget versus actual. It's just to make sure this piece of paper is telling you whether or not you're on track to meet the goals that you have for your organization. Now we're going to talk a little bit about the 990. The 990 is an IRS form that's required for nonprofits. It's a public document, so you want to make sure that your board approves it before you submit it. If a nonprofit is incorporated in a state but has never been recognized by the IRS as tax exempt, then they do not have an obligation to file the annual information with the IRS. Now there are several forms. There's a 990, a 990EZ, and a 990N. We're not going to go into it today because we don't have all that time, but ask your accountant about that. The filing deadline is the 15th day of the 5th month after the close of the nonprofit's fiscal year. Again, your accountant is going to know all this, but I'd like to make sure that you know as well. If your organization has never filed a 990 and you are freaking out right now, the hotline is 877-829-5500. Let's make sure that you get that done. Real quick, unrelated business income tax. You've heard of it as UBIT. So often people think that if they're a nonprofit organization, they are automatically tax exempt, and this is not always the case. UBIT prevents tax exempt entities from avoiding a tax liability on a business activity that a regular non-exempt entity would have to pay during the ordinary course of business. Now I'm going to ask that you talk to your accountant about this because every organization is different. If you are charging, for example, if you are doing sponsorship packages that include marketing on your website and it includes links to your members' webpage and their phone number, and they can click through and get business from that ad, is it then UBIT? If an exempt organization engages in a one-time, profitable, unrelated activity, it will not be liable for UBIT because the activity is not conducted on a frequent and continuous basis. This is true even though the activity is unrelated to the exempt purpose of the organization. If, however, the activity is performed on a recurring basis and is unrelated, the exempt organization will be subject to unrelated business income tax. Again, ask your accountant. Does your organization have a reserve policy? If you don't have a formal reserve policy, I would absolutely recommend it. But as a step to that, let's make sure that you and your board understand what your fund balance should be and how much you should have in reserves. An operating reserve is an unrestricted fund balance set aside to stabilize your organization's finances by providing a rainy day savings account for unexpected cash flow shortages, expenses, or losses. These might be caused by delayed payments, unexpected building repairs, or economic conditions. Reserves should not be used to make up for income shortfalls unless the organization has a plan to replace the income or reduce expenses in the near-term future. In short, reserves should be used to solve timing problems, not deficit problems. A commonly used reserve goal is 3 to 6 months' expenses. At the high end, reserves should not exceed the amount of 2 years' budget. At the low end, reserves should be enough to cover at least one full payroll. That's the lowest end. However, each nonprofit should set its own reserve goals based on its cash flow and expenses. Organizations that have contracts or fees with regular or reliable payments don't need as much in cash reserves as organizations that rely on periodic grants, fundraising events, or campaigns or seasonal activities. To be a viable operating reserve, there should be a board agreement and a policy about how reserve funds can be used, when they can be used, who is authorized to use them, and how this is reported to the board. Does your organization have an investment policy? Why is that important? Let's dig in a little bit. The board of directors for a nonprofit organization has a fiduciary responsibility to the members of the organization to make sure that the nonprofit's operations and activities use the assets to further the nonprofit's mission. When your organization has put money into reserves, it may be in your best interest to invest part of your reserves. CDs are low return and lock your money up for the duration of the CD. Stocks and bonds carry a certain risk. What I would recommend is interview financial advisors to find out how they would invest your reserves with low risk. You can find samples of investment policies online or here on our website. Your financial planner will also help you write your investment policy. Insurance for your organization is critically important. What I'm going to do now is just list a number of different insurance policies that you may want to consider, and I would advise that you talk to your insurance agent to find out what is best for you. General liability insurance is a given. You're absolutely going to have a general liability policy. You may want to consider listing your events individually on this policy. Talk to your insurance agent about that. Directors and officers insurance is another policy that you're absolutely going to have. Others include theft and fraud insurance, professional liability insurance. This protects against mismanagement and sometimes called errors and omissions or malpractice. Auto insurance is if your staff uses any vehicles for nonprofit activities. Product liability insurance if you sell products to the public. Property insurance if you own or rent space. And an umbrella insurance policy increases your coverage into the millions for a very nominal fee. So financial management, are you still with me? Are you still awake? I threw a lot at you in a very limited amount of time.
The Solution is an association management company that maximizes your value and potential while stimulating growth and engagement for your organization. We are skilled facilitators in strategic planning and board orientations. We are masterful at membership engagement, leadership development, and event planning. If you are looking for education, facilitation, or guidance for your organization, we are the Solution.